Welcome, everyone. Thank you so much for joining us this evening. I'm so excited to bring you a presentation with one of my very best friends in the world of real estate, Mr. Christian Szpilfogel. Absolute wealth of information, has the most unique and creative mind, and I'm so excited that he's here to talk to us this evening about how to reposition a multifamily property. And this is something that I've seen a lot of investors do, that I've done myself, but in terms of like the planning and the numbers, I don't think there's anybody out there who does it better than Christian. So we're in for a real treat tonight.
Thank you.
You're welcome. So what we're going to do, quick welcome and introductions, and then it won't be a panelist discussion. Well, it'll be a panelist of one, because Christian's going to actually share a couple of case studies with us, and he's going to share real numbers, which I think is even more inspiring and even more transparent in this sort of day and age of fluffing stuff up for social media. We're going to see actual numbers on real deals that Christian has actually done. We will have a question and answer period at the end of our webinar, and then I will come back on and wrap everything up for the evening. And just to clarify for everyone, if you need to pop out early, this webinar will be recorded. The recording is sent to everybody who registers to attend, whether you're able to be here tonight in person or not. So everybody will receive that by the end of the week. And then if for some reason you missed it in your emails or you want to share it with somebody else, it'll also be available on my YouTube channel. So I know I shouldn't spend time doing this, but I'm going to do it anyways, just to be on top of things. So for those of you who might be unfamiliar with Zoom webinars, what happens is there's going to be two different ways that we're able to communicate with each other. Christian and myself are the only ones, obviously, with cameras on, but if you want to comment or add to the discussion, then please type it in the chat box. You'll see at the bottom of your screen, there'll be a little icon there for chat. So discussion back and forth, responding to Christian's questions if he asks them, use the chat box for that. If you have questions that you would specifically like Christian to answer at the end during the Q&A period, then please type in the Q&A, click on the icon, the Q&A icon, and use that in order to be able to put questions into the queue for Christian to answer them at the end. We're going to try not to interrupt his train of thought while he's on a roll, and we'll try and keep all the questions till the end. Just a reminder with the chat box too, you can see here when you look at, oh, you can't see my cursor, never mind. Okay, here we go. So you can see here, there's the little drop down. So Zoom, for whatever reason, defaults to hosts and panelists. So if you don't click the drop down and change it to everyone, then the only people who see your comments is going to be Christian and myself. So please, right now at the beginning of the webinar, go to your chat box, click the drop down, change it to everyone, then we'll be good to go for the rest of the webinar. Don't forget to use the Q&A tab, which is right here. Don't forget to use that for questions for the end of the webinar. As always, I'm your host, Elizabeth Kelly. I was doing the math the other day and realized I'm approaching 20 years as a real estate investor, which kind of blew my mind just a little bit. But I'm also a coach. I was a trainer for Rich Dad, and I am honored to be able to bring you as much knowledge and information as I can to help you on your real estate journey from my network of professionals and amazing people like our guest, Christian. So Christian is also an experienced real estate investor, has this tremendous background in technology, has a head for numbers like nobody else I've seen. You guys are going to see he's done a fantastic job this evening of putting together a presentation that goes right from the first, the first few slides are kind of the basics to make sure that everybody's on the same page. And then Christian's going to give it gas and we're going to dive right in. So thank you again, Christian, for joining us. Christian's also a coach, by the way. So if you're looking for someone with a head for numbers to give you a hand with some of your deals, he is definitely the person to go to. Christian, it is all yours, and I will flag you down if we get to 8:15, but I'm excited for your presentation. Thank you.
Wonderful, Elizabeth. There's actually quite a lot to get into on this. So what I did through this presentation for everybody here is, I'll be perfectly honest, if you're running business case, there has to be math involved. Okay, there's no way around it. What I tried to do is keep things really simple with the math. as simple as it could be without losing the integrity of the presentation. So the work that Elizabeth was talking about that I had to do around this was very much about normalizing everything, because of course every deal is different and therefore every spreadsheet is different. So I converted everything into the same type of spreadsheet all the way through here. This is how you can get in contact with me if you have any other information. Or want to talk about other things. But just because I know that some of the initial stuff that we'll talk about can be a bit dry, I just want to give you a little bit of a teaser. Here is one of the projects we're going to talk about later. I acquired 2 properties here. It was a mixed-use building with 6 units and 1 commercial unit. Plus, I also bought a house on a lot that was adjacent to it for strategic purposes. Bought the whole thing for $850K with a 90% vendor take back, so seller financing at 4.5% interest only. We turned over 1 commercial unit and 4 residential units, and we did less than 10K of capital investment. We refinanced it just over a year later, and with a conservative appraisal of $1.37 million just for the mixed use piece. And we took a loan out on that port for at 85% loan to value. Obviously, CMHC was doing the insurance on that. And we pulled out $624,500 on the mixed use only portion. Plus, we still have that house and land for redevelopment. Plus, there's additional upside in the mixed use building. So that's just a bit of a teaser, and we'll go through the details on that a little bit later, but I want to give you a feel. So, basically a year later, we pulled out 1.1 million of capital out of this project altogether. Clearly there was another 624 of equity take up. And some of you are probably saying, what does that all mean? So we will get into that. So here's just a breakdown of what we're going to do. I have to go through some basics just to make sure everybody's on the same playing field. I know some of you are very experienced and you will understand most of what I say in the first part of it, but because everyone's at a different level, I need to explain some of this stuff. And then we're going to get right into some examples. I've picked 3 projects. There's some of my smaller projects, but I picked on those specifically because I think they were easy for people to understand and gave examples of easy repositioning and mediums and some challenging one. And just to be clear, what we mean by repositioning usually means that you're taking a building with an existing use and you're changing the use in some way. That could be as simple as simply being able to increase rents, if you will, or it could be taking 3-bedroom units and converting them to 2 1-bedroom units, or it could be completely gutting the internal of the building and completely changing the layout. And we do this not just, I focused on multifamily and mixed use, but we also do this on commercial buildings as well. And it's basically the same recipe, okay? There's nothing really different about commercial, like industrial or retail, any different than multifamily, other than the leases. Also, I just want to make sure that I'm talking about a lot of numbers. I'm talking about some accounting principles. I'm not an accountant. I'm not a lawyer. I'm not a mortgage broker, blah, 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 right? So I'm an experienced business person. In any venture that you do, I will always tell you, you need to talk to your professionals within your team. I do. Whenever I start a project, I'll talk to my accountant, I'll talk to my lawyer, I'll talk to some of the other professionals that are important, including insurance as well, to make sure that you talk to them before you start on the venture, because they're going to give you good advice on structure. Now, on to the basics. Inflation, everybody's favorite topic these days. This is a slide that I used actually a couple of years ago, and I'm sure Elizabeth recognizes it. I want you to understand that if your debt is managed properly, inflation can be a friend of yours, because inflation is not about the increasing of asset prices. It's actually about the discounting of the dollar. Okay, it's really just that simple. So the currency gets devalued when there's inflation in place. And so what that means is, if you think about the property that you have, the debt gets cheaper relative to the value of the property just by inflation. So if inflation is fairly high, your debt gets cheaper fast. And if you're paying, say, 3% interest on that debt, and inflation is running, say today at about roughly 6%, that debt is really cheap. Okay, the lender is at least virtually giving you 3% extra money every year. So that's just, a simple thing. Now I want to put this into perspective because people will think, okay, I kind of get it. But here, I wanted to give you an example of a centurion 2,000 years ago was paid roughly 38 ounces of gold per year. That was their salary. And if you take a look at a modern empire, right, such as the captain of a US Army captain, if you take 38 ounces of gold, right, when I last ran this, it was roughly $64,000, right in the middle of the range of a pay range for a US Army captain. So you can kind of see that what happens is the intrinsic value of that asset really doesn't change very much, okay, but the currency does underneath. And it's the same with property. Property, intrinsically, it's an asset that holds the store, it stores your value, of your currency, regardless of what the currency is doing underneath. Now, historically, property and land actually appreciates slightly faster than inflation, right? And that's probably because of population growth and population changes, and that's aggregate on a worldwide basis. So that's a key thing to understand. By default, if you don't do anything to the property and you're just buying it and holding it, that asset hasn't really changed its intrinsic value. It does what it was always doing, but the money associated with it got cheaper. Okay, so moving forward, understanding some of the financials. Okay, at a very basic level, right, we can see that at the top part you have revenue associated with a particular property or business that you have as income. And then you have operating expenses associated with it. So that's your taxes, your utilities, etc. So revenue would be your rent, utilities would be a form of operating expense. The revenue minus the operating expense is your net operating income. Okay, and that's an important number. Everything in commercial properties, so if you're looking at multifamily buildings, industrial buildings, anything like that, this is the key number that you're always looking at that determines things, and you'll see why in a moment. And then you take your debt charges, so your interest payments that you're making after that, and interest and principal payments, you take that off the net operating income and you end up with your cash flow. So that's the free money coming into your business. So what can you do with these parameters really quickly? You can figure out, for example, the cost per unit, which is a metric that I typically use. This one's important. You want to know what the cap rate is, and that's literally the net operating income we talked about divided by the property value. So basically, how much money is that building making relative to the price or the value of that property? And I can't get into cap rates in any more detail tonight, so hopefully that's something that you can research offline. But that cap rate is really important because in combination with your net income, so remember, revenue minus expenses is your net income before debt servicing. So if you take that net income and you divide it by the local cap rate, that's going to define the value of your property. And you'll see that in some of the data that we show later. Coverage ratio is necessary because your lender is going to be care very much about it. And we won't get into specifics, but suffice to say that you need to be able to generate more net operating income than your debt servicing. Okay, and the ratio is usually at least 1.2. And then cash on cash return. This is a really important metric because for the dollar that you put in, how much money are you getting back out? And everybody has a different criteria. For me, I like to see at the initial part of a project, if it's not a forced appreciation play, I'm still looking for at least 20% cash on cash return. To me, that's a nice thing. But when I'm done a project, my focus is to get an infinite return, which means that I don't have any money left in the project. And you'll see what I mean about that later. And then this is the tricky one. So this is one most people haven't really become familiar with. It's a concept called an internal rate of return. But in any business, your finance department will absolutely be using this as a way to judge a business case. And it's worth understanding and worth researching. It really translates very loosely as an annual rate of growth, right, that an investment can be expected to generate, okay, and taking into account inflation. Now here, unlike those other formulas above, right, this is what an IRR formula actually looks like. Okay, it's a scary beast. So don't worry too much about that. Microsoft Excel actually has an IRR formula. So once you understand the concept of how to set it up, it will actually do the math for you to calculate these things. I would not want to do this by hand. It's not fun. Okay, so basics, income versus assets. Usually people tend to mix their financials together. So I want to separate things out very clearly here. You have an income statement, which talks about all your revenue and expenses, okay? And then you have a balance sheet, which talks about all your assets and liabilities, i.e. what you own and how much you owe. So let's turn to the income statement first. If you take a look at it with your revenue, it's everything. It would be your gross rents, it would be parking revenue, it would be laundry revenue, internet revenue, storage, whatever else you can include. And on your expenses, it would typically be things like utilities, property taxes, insurance, etc., and whatever other expenses you may have. And just like I said on the previous page, the net operating income is the revenue minus the expenses. So that generates your net operating income. And then on most income statements, you'll take the interest expenses off from there, right, or the carrying costs. And then depending on what type of income statement you have, you'll also normally take off any income tax expenses. And then that tells you what your actual free cash flow is. Okay. In some formulas, they don't take the income tax off, so it's income before taxes. Okay, so if there's any accountants on the call, you'll definitely know what I mean, and I'm sure you'll probably even want to correct me. On the balance sheet side of it, you have things like your building, the land, any equipment you might have, and then the liabilities, the mortgages that you have, the accounts. And the owner's equity is the sum of those assets minus the liabilities. And that's what the owner equity is, or what the net worth, if you will, of that particular asset and that property. So in this particular case, and what normally happens when you buy a property is there are two pieces to it. There's the land value, and then there's a thing called the fixture, or which is really normally the building value. And normally your accountant will have a discussion with you on how to proportion that out. For the most of our exercise today, that's not going to matter too much, but just so you know that that's something that's important. Now, to make money, you have to either get income from the cash flows, right, which is that left side on the income statement. So at the bottom line, the net income that you have there, that has to generate money. So that's one way to earn money. The other is to do something to make your balance sheet what they call expanding the balance sheet, which means that you're either increasing revenue, reducing liabilities, whatever it is, that expands a balance sheet, it increases your owner equity. And if you're doing something like forced appreciation, where you're doing renovation work or repositioning work or anything like that, you're usually doing it because you're trying to expand the balance sheet. Okay, so that balance sheet expansion is the main way that you create new money for your business. So the way I tend to look at things is I run my business from the cash flow. I fund the staffing, I fund the day-to-day operations out of that income statement. And then it's also where I get my money to live on. Projects are funded out of the balance sheet. So I take on more debt, right? Finance a particular construction project or a refinancing project or a new acquisition. That comes from the balance sheet. And I try not to mix the two, okay? That's where a lot of people get confused. If you borrow money off your balance sheet to fund your operations, it's probably because you're in a negative cash flow situation, and that's not healthy, okay? So just to, if I then take those income statements, the sum of all your property's income statements is part of your operating plan. That's the baseline of your financial operating plan. I'm not going to dig too much into it, but what you're going to want to do is make sure that on your operating plan, you understand where you're getting all your cash flow, right, for your day-to-day operations. Okay. And then ideally what you want to do, especially if you're running it fairly close to the line, is you'd like to do a month-to-month or month-by-month breakdown on what your cash flow position is. That includes all your income, all your expenses from your business. Okay. And just some quick tips on how to optimize cash flow. There's actually some great presentations out there already that talk about various ways. I know that Seth Ferguson has someone presenting at the multifamily conference this weekend who's going to talk about some great ways about optimizing cash flow. But optimizing cash flow is absolutely key to survival of your business, right? And investing is a business. Let's be clear about that. And the fundamental principle is collect your revenue as soon as you can and pay your suppliers or your expenses as late as you can. Practically can. So for example, if you're looking at expenses, if you're someone who's paying your bills as soon as you receive them, that's not good cash flow management. You want to pay it on the due date, right? Or a day or two before the due date. That way the money's sitting with you for your operations. Sometimes if a supplier says you need to pay me within 30 days, you can negotiate terms. Sometimes you can say, well, I'd like to pay you in 45 days or 60 days. And often that can be negotiated. It's not just the price that you're going to pay someone. It's also what the payment terms are to expand your cash flow. Capital expenses, right? I typically like to finance those, especially when money's cheap. And I know that the project has a finite end and I'm going to do a recovery on that stuff later. One that a lot of people don't maximize is amortization of debt. So the way I think about amortization is a lot of people like to do a 25-year amortization on a mortgage, for example, sometimes even shorter because they think they're paying down their principal faster and therefore reducing their carrying cost. But remember what I said earlier about the fact that inflation makes your debt cheaper. So over time, that debt is going to get smaller just because of inflation. So you still have to use this intelligently, but the right idea is rather than paying the bank principal that I can't take out until a refinance event, I'd rather take that money as a form of cash flow. And if I'm worried about it or conservative, instead of leaving it with the bank, I'll just put it in a reserve fund for a rainy day. And it accomplishes pretty much the same kind of thing. So I maximize cash flows by getting extended or amortizations. And I have some of my buildings with 40-year amortizations. And then, of course, you want to avoid excess inventory. So there's all kinds of other refinements on this, but it always comes down to, effectively collect your revenue as early as you can, pay your expenses as late as you feasibly can. And just remember, just because you want to pay things later, watch out for things like your contractors and so on. Don't mess them about because they're really important to your project. Okay, so next piece. Allocation of debt. This is an important concept, okay? And you know what, you're probably going to want to watch this video later on in order to capture all this stuff. So that's why I'm going to move through a little bit quickly here. So allocation of debt is really important because most people don't think about this properly. So let's just take the fact that you've got an original property. This is clearly a balance sheet. The value of the assets, the building, etc., is just over $1 million, so $1,050,000. Your liabilities are, with mortgage and maybe an accounts payable, i.e. it's an invoice you still have to pay. That sits there at 805, meaning that your owner equity on that building is $245,000. Now you do some improvements on that property. And now the building, presumably you didn't do anything to the land, so the land is probably still $250,000, but you did something to the building so that it's generating new revenue. And now it's worth, say, $1,245,000. You still have the same equipment, same accounts receivable, just to keep life simple. And then in order to do those improvements, you probably went and borrowed another $100,000, right, from somewhere in any means. And now that's added to your liability. However, because that $100,000 went to increasing the value of your property now up to $1,245, then owner equity is now $640,000. That's really what happened there. Your liabilities went up, but your asset value went up even more. Okay, now let's pay attention to this part carefully. Okay, that's your owner equity. So originally we put in $245,000 in the property. We had an original loan of $800,000. We borrowed another $100,000 in there. So the total debt right in that property is $1,145,000. Okay. Now, because the value of the asset's gone up to $1.545 million, I can go and get a mortgage of, and I just use it as an example, of $1.2 million. That works out to roughly 77% loan to value. So it's quite realistic, right? You could probably get more, in fact. So there you go, 1.2 million. Now I have to pay back the original mortgage of 800K. I have to pay back that 100K that I borrowed in order to do those improvements. I'm now recovering, well, there's that original 245, but now that 245 that I put in the original property, I can take that out. And if you take that original 245 out, now you don't have any money left in that property. And remember what I talked about with cash on cash return. If you've got no money in there and zeros in the denominator, whatever cash comes out of it is now an infinite cash return, okay, which is the best place to be. But look, I also took out an extra $55,000 of equity, meaning that now, instead of when I first bought the property, I had $245,000 of working capital, which I used to buy the property. Now I've increased by another $55,000. So now I have $300,000 to work with. And some people say, yeah, but you still have $345,000 trapped in there. So how did I get that? If I took the asset value of 1.545 and I subtract out the new mortgage of 1.2 million, I'm left with $345,000 in there. So I can't really help that, but if I sold it, I'd be paying a lot of that in taxes anyway, okay? And it's equity there that if you needed to take out a second mortgage, right, maybe to take it from 77% loan to value up to 85% or 90%, there's still some, you know, what I'd call a fire escape of money that's there, right, if you need it in a pinch. Okay, so now I've got that $300,000 that available, burning a hole in my pocket, and I got to do something with it. So now I'm going to go buy something new. Well, now I went and bought another property that's worth about 1.3 million. And then I was able to get $1 million mortgage on it, which is very realistic and probably lowballed, but depends on the debt coverage ratio and a bunch of other things. And I'm taking that 300,000 that I just earned of new capital, and now I'm putting that into the property. Now, this is the important part. This is really important, this next piece, is that $300,000 that came out of the original property is now debt associated with the new property, the new acquisition. That means any interest payments that you're making on that $300,000 is deducted from the revenue of the new property. Now, this is important for two reasons. One is this is the way CRA likes to see it. The second is that this is the right way to capture the real debt that's on that original property. That extra $300,000, the property is just acting as a lien for the loan, but the use of that money doesn't involve the original property at all. It's involved in the new property. So what that means is when you're taking a look at your income statement, right, the income from your operations of that property, you don't want to be carrying that interest cost on that original property. And therefore your cash flow is actually going to look better and you're going to properly count that. Okay, it's always on the new property. Okay, and the new property has to carry its own business case. Okay, so I'm sure you probably want to think about that one a little bit more, but it's a really important concept because I see a lot of people don't think about this properly, and they think because they're doing a refinance and they're now taking a 1.2 million mortgage on this property, they think that they're getting no cash flow out of their original property. That's because you're not allocating the debt in the right way. Okay, if it was cash flowing before the refi, it's still cash flowing after the refi because the difference is on the new acquisition. Okay, so let's move on. Some final thoughts on debt. It is a powerful tool, right, in the world of real estate investing and in general investing, but in real estate, it's typically a lower risk vehicle. Okay, but I have to insist on this. It has to be treated with respect. Whenever you're dealing with leverage, you're taking on a certain amount of risk associated with it. So taking on that debt is good, but it has to be managed properly. And some people say, well, I'm going to finance a property at 90% loan to value or 100% loan to value. And that's absolutely okay. I do it all the time. Okay. But on my overall portfolio, I manage a debt to asset ratio of roughly 65% maximum for me. Okay. That's my personal preference. Some will say that it's more efficient at 75%. And there's lots of businesses that run there. You know, in times of uncertainty like we are right now, you never know what's going to happen. You want to have enough equity in your portfolio that you're not caught in a situation where a lender decides that you're going to have to pay more money in order to keep your loan. Okay, so so for me, that I tend to run it at 65% max, and right now I'm actually too low. I'm probably at about 45 or 50%. And you want to protect from your downside, or protections from your downside. So I showed you some ways to expand your balance sheet earlier, right? I.e. generate more equity, but you don't have to do it as a refi, right? In order to fund your next project. Let's say the economy goes kind of wonky, right? At the end of your project, you might decide to hold off on a refi and leave that equity in the property so that it's relatively low debt to asset ratio, just to weather a storm. So the exit could be two-pronged. It could be, if conditions are good, I'm going to do a refi, I'm going to take the equity out, do a new project. Or you can retrench, right, if things are rough, and you can then go to just preserving that equity until the conditions are right. So how do we define opportunity? So if the key question that I always have to ask, and this is why I alluded back to the asset discussion and inflation earlier on, is, are you investing or are you speculating? Okay, so if you buy, say, a rental house and you don't plan to do anything specific with it, you're just planning to buy it, continue the operation, you're basically holding the asset as a hedge against inflation. And that's fine. So at the bottom line is your money is not being devalued by inflation, and that's a perfectly acceptable investment strategy. If you're buying it because you think that market is hot and it's going to go up, then that's speculating. Okay, it might happen, it might not happen, it might go down. You don't know, right? So lots of things can actually happen here. So understand the difference between investing and speculating. What I do is investing. Sometimes there's some speculation, right? But it's usually because I'm land banking or there's some natural appreciation. So my rule of thumb, right? And whenever someone is talking to me, you'll always hear me say this, right? I want to acquire a building either with cash flow or with line of sight to cash flow. I.e., when I buy it, it's either going to cash flow or I have a business case that's going to get it to cash flow. Okay. And I'm not waiting for the market to do it through natural inflation. That's sort of a far fallback strategy for me. So I like deterministic outcomes. I focus on the business case. Like I said, I work towards the cash flow and I do some form of forced appreciation to expand the balance sheet. Natural appreciation due to things like inflation, urban or rural to urban migration, any of that stuff, That's just upside. I don't factor it into my operating plan. I don't factor it into my business case, nothing. Okay, it's just upside for me. So defining an opportunity, you want to be able to do that to define tangible outcomes within a discrete amount of time. What do I mean by discrete amount of time? Is your plan to do this within 1 year, 3 years, 5 years? Some of my plans are short. Some of my plans extend out to 5 years. I even have some plans that go on beyond 5 years. I have a focus on cash flow expansion. That's one of my priorities. And it was right from the beginning when I quit my day job and focused on this. Cash flow is key to being able to put food on the table, to be able to, pay my other obligations, to watch Netflix when I have time, and pay for Netflix. It's also what I need to have to pay my staff. So predictable cash flow is important, and expanding that cash flow is important. I like to, at the end of every project, I try and take capital out that I can use to other investments. Now, if you think about that, as you own more assets, this becomes a non-linear function, like it becomes a curve. So the more of these things you're running in parallel because of your capital, the faster that appreciation works. All right, I'll let you guys noodle on that because you'll probably figure it out after a bit. I like to extract working capital, additional working capital, and I always like to be in a position that when my project is done, if the world goes wonky, I can be in a deleveraged position, okay? And then my exit, because I'm getting all my original equity back out, right? There's an infinite cash on cash return, the best kind of investment there is. Now, why do I use an internal rate of return, that crazy formula I showed you earlier? Because this is why businesses do it. They like to compare an investment opportunity. If I put $1 here versus $1 there or $1 there, what is my return actually going to look like? And I have to consider my working cost of capital, right? So I won't get fancy on that, but think of it another way. Think of it as inflation. So what's your value now, adjusting for inflation with future money? Okay, so my hurdle rate, if you will, is my business case has to have at least a 30% internal rate of return, or IRR, for me to consider this to be a good business case. If it's below that, I think it's too marginal. It's probably not going to allow me to get my working capital back out. But if it's over 30%, then it's usually pretty clean. Some ways to generate value. I gave a few things here. One is just natural rent increases on turnover, right? And when you're buying a property, and when I look at a property for rent increases, as much, if that's part of my business plan, I don't force people out the door. Okay, if they're good tenants, they're welcome to stay with me. I'm not one of these people that pushes people out. Now, if you're a nasty tenant and you're misbehaving and you're, affecting other tenants and affecting reasonable enjoyment, etc., well, that's a different story, right? So that's one way. So that you got to think about the demographics that had that natural turnover. So I'm sad to say that if a building is full of people in there that are senior citizens, lovely people, I've got lots of senior citizens in our building, but those buildings are not going to have natural turnover. So my business case can't rely on that. Okay, so that's something. But if they're in their 20s, lots of people have life events. They'll naturally tend to move every few years. So you can kind of wait for that to happen. You can add additional services. So in my case, we add storage. Sometimes we'll add laundry, depending on the building. We'll add internet services or television services, etc. So there's lots of good ways to add additional revenue, which all counts to that net operating income. We can renovate and re-rent, or we can reposition. So for example, one of the first repositionings that I did was a 6-unit building. We converted it to 9 units. But all I did is most of the units stayed intact. I took a 3-bedroom unit that was quite large, and I split it in half and created 2 1-bedroom units. And then I added 2 additional units in the basement. Okay, and they're all very good quality units. But by doing that, for example, taking a unit into a one bedroom unit, that can actually increase the revenue per square foot by about 50%. So just to give you a round ballpark. So sometimes we do things as simple as that. Sometimes they're more complicated. We've got an industrial complex that we took and converted into 15 small industrial units. That generated a lot of increased revenue per square foot. You can change the entitlements on a property. So that's a land development play. And you can do severances. That's another way to do things. Okay, so now we're going to get into the examples. So all of that background that you have explains why I did what I did here. And this was the teaser at the beginning. I'm going to go into a little more detail now to explain how this worked. This was probably one of the easier ones I did. The negotiations were harder than the actual business case. So this building, and it's actually two buildings. There's a mixed use building that has 6 residential, 1 commercial unit. It had been fully renovated in 2015. The seller had already renovated this. There was no work for me to do in the mixed use building. The house that I negotiated into the deal is adjacent to that mixed use building. So in my, I wanted to include that in the deal because I want to be able to take that mixed use building and extend it all the way back to the next street. So it's part of my expansion plan. And so that house is really a land banking play. Now there's a tenant in that house that's largely paying for the mortgage. It's slightly cash flow negative, but that's okay because the rest of the business case supports it. So it was listed for 1.2 million back in 2018. And you can see why he thought that was the right price, but there were no takers, right? It came to a cap rate of 4.2% in that particular town, when for mixed use, the market was roughly at about 7%. So it was priced too high and it wasn't selling. And I'd had discussions with the seller and he just absolutely, the best I was able to get him to was just shy of $1 million. But then he backed out. He said, I can't do it for that. And that was that. And I'll explain how that deal closed later on. So the tenants, the commercial tenant was below par. It was, I'd say, a Class C tenant in the commercial space, but on a main street. It was, all the residential were quite a bit under rent. I think it was an experienced landlord that he was, tired and took his eye off the ball, didn't see what rents were doing in the town. On average, people were paying about $900 a month, and I'll show you in the spreadsheet in a minute. Whereas a very conservative estimate at that time was that the rents should have garnered at least $1,300, right? And if I was being optimistic, it would probably be about $1,500 at the time. But as you'll see, my business cases are always based on conservative assumptions. As I've mentioned, the building was newly renovated, including a brand new elevator, right? Now, I don't know if you have ever priced an elevator, but an inexpensive elevator is going to run you just shy of $100,000 on its own, right? And this was a brand new baby. And I mentioned the adjacent land use already. Okay, so the options I had, I could turn over the commercial tenant to get better quality. I could turn over any problematic tenants, which I'd already spotted a few. The demographics, for the most part, were relatively young demographic, with the exception of 2 units where it was, retired folks. And we were just going to wait for some tenants to leave naturally. That was an option. The land development, were we going to just now, hive off the house and sell it off to redeploy that capital, or were we going to land bank it for future expansion? In the end, we decided we were going to land bank it. We also had opportunities to reduce the overall expenses on this property through things like I do automation in all of my buildings, and you'll see a little bit of that in one of the next examples. And then, you can do things with commercial tenants. If the leases aren't structured right, a good commercial lease for a commercial unit is going to have a triple net lease. What that means basically is they pay a rent and they pay all the expenses associated with the inside of their unit, including the share of property taxes, a share of insurance, and all the utilities. So that's a bit more advanced and, another discussion. Now, what did I end up doing? so I finally came to, and this was a negotiation that took a span of time. Some of you on this call all have already heard this story, but I ended up offering him, you know, and I worked through it in detail with him to show him how I came up to this value. I said, look, it's worth $795,000 to me. And oh, by the way, I'd like to take a vendor take back on that, and I'm willing to give you 6%. In the end, what we ended up with was $850K purchase with a 90% loan to value on that seller financing at 4.5% interest only. And you might think, okay, well, 6%, you know, you said it was worth $795. Why were you planning to pay $850? Well, I got him to do that mortgage for a 5-year term completely open. And the 1.5% difference between the 6% and the 4.5% actually is about $60,000. So I actually got roughly what the price I wanted. It was just structured differently. And the seller was happy and I was happy. And I kid you not, this took 9 months to negotiate. So it was a long and slow process, but eventually we came to terms. So now let's run the numbers on this. Okay, here is what it looked like when I bought it. And I'm hoping that's a big enough font that you can read that. If you're on your phone, you're going to struggle. And I broke it down to per unit pricing. These are the actual numbers in this. So you can see each of the units, they were ranging from $850K up to a high of about $927. Okay, so actually below $900 a unit. And the commercial store was running at about $1,300 a month in terms of that. And if we go all the way down, because I showed you guys how to figure out net operating income already, it had a net operating income of just shy of $42,000. And it was generating, you know, on my debt assumptions on the value that I'll talk about in a minute, or that I kind of talked about it anyway, right, was going to, after all the carrying costs, was still going to generate about $15,000 of cash flow on acquisition. I made an optimistic cap rate assumption here in order to help drive the value up, because otherwise I wasn't going to close this deal. Okay, but I knew there was lots of upside, so I was willing to compromise on this. That would have generated a value of the building at $699,000. So then I said, okay, well, what can I do? So as completed, okay, so this is the terminology. We use as is for what it is now, and we use as completed when you're done your business case. I said, well, those units when I'm done, and I gave myself actually roughly 3 to 5 year timeline. That's why I negotiated the vendor take back to 5 years. When you think about it, I only put 10% into this deal. Okay, so $850,000 deal, I only had to pony up $85,000. That's all I needed to close this deal. 90,000 because I had some closing costs, but you get the point. So conservative assumptions on the rent, right? Work our way down here, same with the store, etc. I could then take the net operating income up to $72,000 or almost $73,000. Assuming the same cap rate, I was going to end up at about 1.2 million. Okay, just by doing that work. And I was conservative about this, conservative on the rent, conservative on the timeline, etc. Now, as it turns out, I had the commercial tenant, I rotated out very quickly. They were on a month-to-month lease. They weren't good quality tenant, and I put in a Class A tenant in there who was willing to pay a good rent. The 4 of the 6 residential units rotated out, and we went above our 1,300. We got some at 1,500 roughly, and then we noticed we were able to get as much as 1,800 at that point in time. So we were just catching, the 1,500 was actually realistic, but on the, you know, at the tail end of that, we were starting to see an updraft in rents. So 1,500 now is becoming 1,800, and anything we rent in that building now would be at about 1,800. And even on the commercial side, there's still more headroom. Now, this is at refi. This is an actual appraisal. It was appraised with a 6.4 cap rate, and it was appraised at $1.368, $501. Literally that. Okay, so that's what it was actually appraised at, and then we did a refi on that. Now I'm going to show you what it is now. Okay, so I just took a look at my numbers while I was putting this presentation together. This is where it actually stands. We've gotten some of those other units up to 1,800. The two units that didn't turn over because I said they're older folks, great tenants, by the way, love them dearly. They're great and they help us out a lot. But our gross revenue now is at about 105 for the residential side, and it's at 28 now for the commercial, because the commercial tenant grew and she needed more space. So we leased out the a semi-finished basement, if you will, and she does all her storage of inventory there. So we were able to increase the rents even further. So now cap rates in that town for mixed use is about 6%. And so the value of that building today is just shy of 1.7 million. Okay, and I remember I bought that not even 3 years ago for roughly $600,000. Okay, so I bought it for $850, the house plus the mixed use, and I ascribed a value at the time that we bought it. I said the house is worth $250K, the mixed use is worth about $600K. It was a reasonable guess at the time. I could argue that mixed use might have been a little higher, etc. But that was a key thing. Cash on cash return at the time was 22%. The IRR on my business case was 82%, right? The as is versus as completed. And the cash flow was 15K. At about 18 months after I bought it, I was able to do an equity takeout of $624,000, right? Which meant that including the money that I put into it as well, its share of the money I put into it, I now had total working capital that I could use of $684,000. And it currently contributes $72,000 of cash flow into our business. Okay, this is literally what it does right now. Okay, so you can see it, buying one of these, right, can substitute an income, right, for most people. Okay, so you collect a bunch of these, right, you're turning this into a real business. Example 2, this is sort of a medium difficulty level. So this was part of a portfolio purchase that I just closed in March. It was an off-market deal, and it's on a sought-after main street. A-class commercial tenants, they're really very good. And 3 of the units were already renovated up on the 3rd floor. 4 of the units are at end of life. And all leases, just like in the first case, all leases are under rent. So my objective, again, just like the first case, was I'm looking to do 90% turnover within 5 years. Again, natural, not forced. I don't push people out on purpose. And the residential tenant demographics work for this. Most of the people are in their, state of life where things are always in flux. They're, either young people, or they're, recently divorced, or, there's any number of reasons, but they tend to move on their own. I also did CMHC insurance on this in order to increase my cash flow. And I do that by increasing my cash flow because of the amortization. So I've got a 35-year amortization on this. I had a good loan to value. I think this one's at 82%. And the interest rate with CMHC, the interest rate was relatively low. Okay, so now running the numbers on this one. Okay, so this is a business plan. So as is, and I didn't go into the details of each unit, you guys get how I underwrite this stuff now. We're taking a look here. The expected revenue across all the pieces here is about $140,000. And the gross annual expenses is about $42,000. The net operating income on this building is $98,000. This is just one of a bunch of buildings in this portfolio, and the cash flow is $26,000 on purchase. So I haven't even improved this thing yet. It's generating $26,000. So the value of the building, right, is $1.642 million based on that cap rate, and an appraiser that does conservative appraisals for me, that's the way he does it. Okay, so it was accretive on purchase, which means it adds cash right away. The cash on cash was 12%, right? And depending on your definition, if you'd say, because my money is always a borrowed cash, right, then you could even say it's infinite. but technically I tend to think of every money I put in originally as if it's my own cash. The internal rate of return on this very conservatively is 32%. So it just met my hurdle rate for this building. The other buildings don't have any other work to do. They're already in great shape. So they're already generating cash flow similar to this, but I don't have any work to generate the upside. It's just turnover. But this is the medium case because there is some work to do. So here it is on the balance sheet. So I bought it for 1,642. I've got a first mortgage of a 1.185 and the borrowed down payment, which really is just coming from one of my other assets that I refied before to pay for this. So I kind of, even though the appraisals came out to higher than my original purchase price, I always assume it's a fair market transaction when I bought it, and therefore I assume the owner equity is zero when I buy it. So even though you're buying, you know, as some people say, you buy at a discount when you buy it so that there's money in the deal. True, but I still pretend like that original purchase was still at fair market value. So on the as completed on this project, the gross revenue on when I turn everybody over here over that period of time, I'm going to end up with 184,000 of gross revenue. I'm going to have a net operating income of 142, cash flow of just shy of $70,000 on this. So again, just using today's cap rate, and cap rates in 4 years might actually be lower. They might be a little higher, who knows? But using today's cap rates of 6%, that yields a $2.3 million value when I'm done on this. Okay, right there, sorry. Yep, there's the $70,000 of cash flow. So same as before, conservative assumptions on the rents. And so now take a look at what happens to my balance sheet. Okay, so once I've done those improvements, the asset now is worth 2.369, etc. I still have that mortgage of 1.15, the original borrowed down payment of 457. I expect I'm going to put $240,000 of renovations to do those units in today's dollars. Okay. And I'm doing everything in today's dollars. That's why I use IRR. It calculates things as if it's today, right? And it just makes your math simple because things go up in price later on too, right? So the renovations are at 240. The owner equity then is increased to 522. So if I do a refi on this based on that new value of 2.369 at 80% loan to value, which is pretty easy to get even with CMHC if you're doing your math right. The equity takeout is $48,000 plus my recovered capital of $697. So my working capital for another project is going to be $745,000. You see the way I think about this stuff, right? I'm always thinking about where the money's coming out and coming from. Okay, so there's that equity takeout, right? And yielding that $745,000. And I have no money left in the deal. It's an infinite return as you've noticed. Okay, so now challenging. Okay, this isn't the most challenging I've had, but this was one of our earlier challenging ones. This one was a complete gut. Okay, so we bought this thing in October of 2017. It was in a high-end neighborhood, like a Class A neighborhood. I'm talking doctors, lawyers, research scientists, university professors. That's who lived on the street. And this building had so many problem tenants. We had people that had severe addiction issues that were really causing a lot of problems in the neighborhood. We had, as it turns out, a thief in there as well who was stealing from local construction sites and later attempt to break into our construction site for the same reason. That's a whole other story. So it was real problematic, and every one of the neighbors was very supportive of what we were doing because they knew we were going to improve the property. And that can't be understated. I mean, this is very important when you're trying to get their support for things like planning committee of adjustments, etc. It's good to have the neighbors on side. So we were converting this thing. It was a triplex with one additional illegal unit. Okay, not as some realtors like to call it, a non-conforming unit is usually code for it's illegal. okay? There are very few truly legal non-conforming. They exist, but it's usually what's not met, what not met. So this one had an illegal unit. It had very large 2-bedroom units in there, which we knew we could split. And so the plan, and the interior was basically end of life. So there was no intrinsic value. So our plan was to convert this into 6 1-bedroom units with high-end finishes, and a product that was going to fit into the neighborhood. We were doing lots of automation, multi-zone radiant heating, and I'll show you a picture of how crazy that looks. But basically what that means is each apartment has a thermostat for the bedroom, a thermostat for the common area, a thermostat for the bathroom. People like their bathrooms warm in the morning. They like their bedrooms cool at night, and the common area should be typically room temperature. So we did that with radiant heating. And we retained the original structure, unfortunately not as much as I'd hoped originally, but it also gave us flexibility in generating new revenue. And our target was to do occupancy by June of 2019. Now, this requires a lot of city approval, it's site plan control, it's all that kind of stuff. And I gave little details. That's 3 of the floor plans down below, the basement, the first floor, the second floor. So we converted it from what you see on the left to what's on the right. And then here's a little picture gallery of the project at that time, back in 2018 timeframe. Basically demolished all the interior, including the basement. We actually lowered the basement floor as well. We put in brand new services, sewer, water, and the water I upgraded. So once you're digging a trench, why am I going to put in a 3/4 inch or 1 inch water pipe when I can put in a 2 inch water pipe or a 1.5 inch water pipe? I can plan for the future, and I plan to be able to put an extension tower on the back at some point in the future. You can see in the basement, we put radiant heating into the floor. We poured concrete on top of that, right? So that's multi-zone heating as well, but it's radiant from the floor. Very comfortable. On the electrical panel, we went overboard on that because we were over provisioning, but we went to 400 amp service. We might have been borderline at 200 amp, and a lot of 6 units are working fine on 200 amp. But because I want to be able to build another tower on the back, I over provisioned the electricity at this point in time. And you can see all the internet stuff at the bottom there on the bottom right. So that's for internet services, cameras, security, all that kind of stuff. And so this is what the product looks like now. Top left is the front finish. You can see all the interiors. They're done very nicely. Everything's stainless. We usually put some sort of architectural feature on the front. We have accent lighting on the building, so it looks absolutely beautiful in the evening. Makes it very easy to attract good quality tenants in there, right? Because of all the finishings. And that crazy picture on the right is our boiler and the radiant heating system with all the little valves that control every single room within each of the apartments in there. So I just thought I'd put that in. So now let's run these numbers because this is our last real example. In this particular case, the as-is rents were grossing 45, almost 46,000. The net operating income was about 31,000. So fair market value, assuming a cap rate of 4.5%, was probably about 693. But remember, there was upside in this project. So based on what we had to do as a loan, right, on that, we bought it at 775. We had a first mortgage of 581 in order to cover that, and a down payment of 193. So it was generating a negative cash flow, but that's fine because that was part of the business case. Because on the completed, what we were expecting is that we'd end up at 86,000 of revenue. Again, conservative assumptions. We were going to end up with 22,000 of cash flow, based on that, and an asset value of 1.35. So if you look at that, you can see you end up with about just over $650,000 in new equity, right, to do that. So as long as, if I spend no more than $650,000, I'm still breaking even on the project. But we kind of went a little further than that. We made some changes in the design that was able to generate better revenues by getting a better quality product. So in the end, when we, at the time we did a refinance, we ended up getting 129,000 of gross revenue out of this. 93,000 of net operating income, and cash flow at $32,000, and a valuation of just shy of 2.1 million. So the as completed balance sheet, there's your just shy of 2.1 million. We had an owner equity of 587,000 in there. We did an equity takeout of 172,000, plus recovered all the capital we put into there, including the down payment, the renovation costs, etc., of 943. So the working capital that came out of that building, right? So there's 943 we put in, plus we took an extra 172 out. So the total equity, that new working capital that came out of after that project, was 1.1 million. So that was a pure business case with a 50%, 52% internal rate of return. The cash on cash at this point is infinite. The cash flow to operations, added to our operations, is another 32,000. As I said, we created 172,000 of new working capital. And as I mentioned, we modified our strategy. And that's a key thing. Be flexible. If you learn something new as you go, make the changes. It's okay. It might cost you a bit more to make those changes, but if it makes sense, do it. Okay. So those are just 3 examples that I thought were pretty good fits. We obviously have a larger portfolio than this. And I'm just going to throw one little bonus one at you. This is one that I picked up about a year ago. This is a 7-unit building built in 1901, hasn't been renovated since at least 1929. And I know that because I found a magazine in the wall, right, which is absolutely cool. So the original plan that we had was we bought this building. We said with an internal rate of return of 43% of the project. So I said I made my hurdle. The forecast when we were done was going to be about 2.9 million. And the renovation costs were about 540 with an equity takeout of 180K. But there's higher risk when you just do it as a straight, 7-unit to 7-unit conversion, right? So just beautifying it. Because with a lot of these older properties, you get surprises, right? So there's risks of those unexpected costs coming in. So I said, well, another way to do this, I had a better business case by gutting it completely, getting rid of the unexpected costs, right? Saying just assume that they're there, and took it out. And then I said, let's convert this from 7 units to 12 units, right? They were really big units, lots of dead space in the building. So by making it more efficient, we were able to get 12 units into this. We're going to do a complete renovation of the front facade, get more living space, better amenities for the tenants. And this internal rate of return is at least 50%. That's based on very conservative assumptions of how much money I have to put into this. Here financially is what happened. It was listed at 1.3 million. My business case said I could afford to pay up to 2 million and still have a good internal rate of return because I had a business case. So I was able to get it for 1.6 million at that time. I've got to put conservatively about 2 million into this thing. Optimistically, it's probably going to be closer to 1.5. And when it's complete on this one, it's going to be 4.8 million, and I'll get a 240K equity takeout plus all the return of the invested capital, okay, which you can see is quite a bit here. So that's currently in site plan control now. So this is a wrap. Here's my contact info, but I'm going to leave you with a couple of key messages in this. Think clearly when you buy something about how this deal is going to add to your operating income and expand your balance sheet, i.e. your net worth. And as you can see, every one of these projects I showed you, I had a plan, right? It was going to generate new income for our business, and it was going to expand our balance sheet. Remember what I said earlier about allocating debt by the attribution rule. It's not just a good idea for CRA, it's better accounting for you personally, right? In terms of knowing what your real cost of that building. The money you do as equity takeout is not on the original building, it's over on the other side. And ensure that you do your underwriting conservatively, okay? It's important because a lot can go wrong. Okay, but if you do it conservatively and the deal works on a conservative assumptions, then you get lots of upside, as you've seen in each of my cases. And then the final thing is, remember what I said about debt. It can be a little bit like handling a snake if you're not careful. So you've got to manage it carefully. There's nothing wrong with an individual deal being a high ratio deal, but make sure you've got ballast in your portfolio. When you're first starting out, that's harder to do, and that's okay. Life is full of risks. Sometimes it's just fine. But as you mature in your investments, look to provide ballast and become a less risky operation. Alrighty. Whew. How's that, Elizabeth? I think you did that in just over an hour, so we have lots of time for Q&A.
That was impressive. That was such a great presentation, Christian. And I always love to see like the way your mind works and the way you look at potential deals, because you and I talk, multiple times a month, sometimes multiple times a week. And, I sort of follow along with you in bits and pieces, but to see you put this whole thing together, that's pretty amazing.
Thanks. Yeah, but this is how my mind works.
It's a fascinating place in there. So we have a number of questions. People are loving it too. So we have a number of questions just to work through. So are you okay if I ask you and you just provide the answers rather than having you read through them and everything?
Yeah, that's probably more efficient.
Yeah. So Corey had asked what your definition is of forced appreciation versus value add versus BRRRR. Like, do you sort of view them as kind of synonymous in your mind, or is there a distinction between them for you?
Yeah, it's a good question. I'd say that forced appreciation is just a generic, broad category that would encompass all of those things. It's about doing something that changes the asset value. Because as I said, if you do nothing to the property, then it's really just parking your money as a hedge against inflation. So it's just a hedge against inflation in that case. But if you do anything to change the value of that property, and more than just changing the rents, because rents typically, the baseline case is just following inflation, okay, as a conservative assumption. But if you're changing something, like the value add is just changing something, that might be adding internet, telephony services, adding laundry, that changes value. Right, makes something different about the business. A BRRRR is that's repositioning done, at a smaller scale, or you could say that BRRRR is really just another term for repositioning. So I think we tend to use BRRRR when it's a smaller project, and we tend to use repositioning because it makes it sound more sophisticated at the commercial level. So,
yeah, absolutely. We always like to be sophisticated.
There you go.
Perfect. Thank you. Nazrullah said, can you please elaborate on the concept of allocating refi amount to the new property and keeping the cash flow the same as before the refi on the first property?
Yeah. So I kind of figured that might have been a bit of a mind bender, right? And so sure, it's worth taking a little extra time now because I really cruised through that fairly quickly. Okay, so what happens by default with most investors is they say, I've got this property, I've increased the value, now I'm going to do a refinance, and I'm going to take out a new mortgage, and I'm going to have a new mortgage amount that I pay every month, which is interest and principal. What most newer investors tend to think about is, okay, that makes my mortgage payment higher on my original property. Okay, and it's going to reduce my cash flow, and it's going to, basically, have the debt associated with it. And that's not the right way to think about it. The amount of money you put in to make the building what it is effectively the debt that's associated with that property. So when you do a refinance, you're extracting money out. New working capital is just taking money out, and you're going to use it for something else. Now, CRA insists that you do this anyway, okay? That you take it from here and you put it over here and you allocate the debt. So since you've bought property number 2, the money that you took out from there to do it as the down payment, the interest and principal on that side is associated with the new property, property 2. The interest costs are deducted from the revenue of property 2. So they're not deducted from the revenue of property 1 where you did the refinance. So if you then think about that and you take that expense and move it to property 2 where it rightfully belongs, you'll see the true cash flow of property 1. The other way to think about it is you think of it as 2 mortgages. You have the mortgage that's associated with all the original money, and then you have a second mortgage for the money that you took out to go buy another property. And that interest cost right, is obviously with the second property. So the only thing that's happening with that second mortgage, you know, if you will, that the second one that you've put for the new property, is the lien is on the first property. But the lien is just a vehicle for that the bank has security. It has nothing to do with where money is attributed. Okay. Hopefully that was helpful.
I think that would be great, Christian. Sorry, I was just scanning through the rest of the questions because all of a sudden the Q&A box exploded and now there's 15.
It's all good.
Yeah, you will just work through them and then I'll keep scanning through and looking to see what we can combine. So George said, how does CMHC affect the loan to value in mixed commercial? And then Michael had asked, how long does it take to do the CMHC paperwork?
Yeah, great questions. Okay, so how does it affect the loan to value? So CMHC is sort of a two-sided thing, okay? So if you go to a conventional commercial mortgage, so first of all, what qualifies for CMHC? That's important because he asked specifically about mixed use. So if it's a pure residential, you know, building with at least 5 units in it, then that's clearly CMHC will do, it will ensure that. If you're a mixed use building, the commercial gross leasable area of the commercial space needs to be less than 30% of the total gross leasable area. Okay, so that's first thing to qualify. Now, the second piece of it is, if you were to go conventional commercial loans associated with that, most lenders will get to about 75% loan to value. And if you want to go above that, they'll want it insured by CMHC. CMHC will allow you to go up as high as 85% loan to value. But there's a little caveat, is that CMHC tends to underwrite the deal more conservatively than a lender might. Okay, so whereas you might get away with a debt coverage ratio of 1.2 with a lender, CMHC, once they've applied all their real rules, it might work out to the equivalent of 1.25 or 1.3. So even though you're getting 85% to the CMHC appraised value, it might actually work out closer to, say, somewhere in between. So I get better than 75%, but I probably end up closer to 80% of what I would have otherwise got. But here's what I do get out of it. I can get a longer amortization out of it. So I can get up to 40 years amortization on these projects, especially if it's brand new construction. So that one of the last ones that I showed you there, I got 40-year amortization on it. The first one that I showed you, I didn't read the appraisal report properly, and the appraiser put in a remaining economic life of 30 years, which limited my amortization at 30 years. And if I paid attention and I didn't miss that, it would end up being at 35 years. That's what I really should have had, and it would have improved my cash flow. So it does that, it does the amortization, improves your cash flow because of the amortization extension. But usually what will happen is most lenders will give you a full point off of the rack rate interest rate because it's insured by CMHC. So they don't need as big a spread to cover their risk. And so you'll typically get, really good rates on that. And it's all driven from the bond market. It's very different than a residential one. Now, I think there was a second question there. I'm not sure if I answered it.
How long did it take you to do the CMHC paperwork?
So that's a interesting question because everything's kind of changed. We usually budget for about 10 to 12 weeks to do the CMHC piece, assuming you've got everything in order, right? And sometimes they come back with questions. I had a deal recently, it was a refi. No, it was a new acquisition. So it was actually that portfolio that I was talking about that I closed in March. That CMHC timeline I got done in 4 days. Right, that's unheard of. And the only thing we did differently was I'd heard somebody had gotten a similar type of timeline. We got everything the way that CMHC would expect to see it. So we didn't expect any questions back. It got in the queue, got pulled from the queue. We had approval in 4 business days. And I was able to advance my close by 2 months, which was good because remember that deal was accretive, right? It added income. I wanted to close as soon as I could.
Yeah. Absolutely. And you don't know with any degree of certainty what the bond market will be doing 60 days later.
Oh, you're not kidding. And in fact, the bond market was going crazy because Russia had just invaded Ukraine at the time. And so suddenly the bond yields were going up fast. And so now I had another reason to close as fast as I possibly could, because I could be paying a full point more if I waited even another 2 weeks. So it worked out really well.
That's good. So Nev was asking, how did you come across the deals in your example?
Oh, wow. Okay. You know, they come at me from all kinds of different directions. So using those ones, the first deal that I showed you with the mixed use in the house, the mixed use building had been listed on MLS and wasn't getting any bites because it was overpriced, but I engaged with the seller anyway. And we, you know, eventually it came off MLS, he gave up, and I kept the conversation going. And then we eventually closed 9 months later. So that was an on-market deal that became an off-market deal, but I still cut the original listing agent in on their commission. We worked that out with the seller, so we should pay the person, right? Because it, you know, that's how we got this deal put together originally. So that's what we did, being fair. The second deal, that was an investor realtor who had gotten it under contract for himself, that was unsure about being able to execute on the deal. I think it was just too big for him. He caught a big tuna, right? And he was still a relatively new fisherman. And rather than trying to pull that tuna in, he cut the line. So that one came in because we were listing apartment rentals in a nearby community. He called us. He said, I noticed that you guys own properties and you're renting things out. He said, would you be interested in buying the property? And so Chownie took the call originally. It's my wife and my business partner. She took the call and she passed it on to me. And I said, well, send me the numbers. I took a look at the numbers and the guy had actually done a good job of underwriting it. I still was able to get it for a better price. So I negotiated it down. But in the end, that one never hit MLS, right? It was effectively a pocket listing and it was a portfolio. The third one was an MLS listing. That one was an interesting tale. So I'm sure some people understand double-ended deals. So if you go to the listing agent, some listing agents will, in Ontario, you're allowed to do this, right? A listing agent can represent the buyer, so it's a dual representation. And in that particular case, it was a 1% realtor, i.e. they do a commission at 1% to the seller. And if there's a cooperating buyer agent, then they get their normal commission. So the total commission would have been about 3.5%, right? If there was a buying agent involved. By going directly to the listing agent in this case, and I don't recommend this for people other than experienced investors, right? You should get proper representation. But I went to, I was experienced enough and I went to the listing agent and I knew for him, right? And let's be honest, real estate agents, like most salespeople, are coin operated, okay? They don't get paid unless a deal is done. So instead of making 1% on the selling side, he now had the opportunity of making 3% on that deal. That was motivation. He helped position us properly with the seller and we got the deal below what was the listing price, okay? So that's how that one went. And then the fourth example I showed, that was an MLS deal, and I was one of 15 people bidding on the project. Most people lowballed it. They took the face value of 1.3. Some people made lowball offers. Some people made higher offers. I knew what my business case could tolerate, right? So I went in at originally 1.3. Then I saw a lot of other offers. We upped our offer right away to 1.6, and that was what was accepted. And I know we were not the best price, but we were the most reputable buyer. So I have a very good reputation in the area. So people will say, okay, if he says he's buying it, unless there's something that's really you haven't declared that's crazy, he's going to close. Okay. And I've also lost a bid to a more experienced investor, a big 40-unit building that I was trying to buy. As I said, I came in number 2, which is really just the first loser, because my bid was really interesting and I was doing above asking, but the one that actually won was all around credibility, right? It was similar. They weren't as confident that I would close as the other buyer. right? So credibility is important, making sure that your buyer rep positions you properly to the seller.
Perfect. That's awesome.
Okay, sounds good. And I'll just finish my, the answer to my other question is that I have a real mix of where sources come from. Sometimes I'm approached privately. Sometimes I go and I see them and I knock on someone's door and, figure out. A little known secret is you can actually go to the town hall or city hall and find out who owns a property. It's public information. And I've done that. So there you go.
Awesome. Thank you so much, Christian. It has been such a pleasure to have you. You're an absolute wealth of information, and I always know that when I'm stuck or struggling or wondering, you're my go-to guy, and I appreciate you very much for being that. This evening, we are going to be giving away Seven Figure Flipping Underground, the book by Bill Allen, who was our investor guest a few months ago. Christian, can you give us a number between 1 and 82, please? And whoever is entrant number, well, the number that you choose, will be contacted by my amazing VA, Mary Beth, and she will be sending you a copy of the Seven Figure Flipping Underground by Bill Allen.
Okay, well, since I'm picking a number, I'm always going to pick the keener. So I'm going to go number 1.
Love it. Okay, Mary Beth, tomorrow, entrant number 1 for the webinar. And if you are new to my real estate community, if this is the first time or the second time you've been able to join us for a webinar, please go ahead and subscribe to my YouTube channel so that you don't miss a thing. It has all of my webinars for the last, I can't believe I'm approaching 3 years now, but all the webinars that I've done and hosted. So there should be a wealth of information there for you, and always open to hearing ideas. If there's something you're struggling with and you would love to hear a webinar on it, please don't hesitate to send me a message and let me know, what questions you have and how I can help you answer them. Here is where you can find Christian and myself if you have any questions around anything that we have talked about, covered, or you would love to see covered in the future. Christian, obviously you have your website and your email. I'm also on Instagram and YouTube, so please do reach out to us. My next webinar is going to be the do's and don'ts of due diligence. So Corey Spurl is my guest. He actually joined us here this evening. He was helping answer a couple of questions, but Corey is going to walk us through when you put in an offer on a property, and it might be a big multi-unit or it might be a smaller one. What are the essential components of the due diligence process so that we can figure out which parts of our business plan are reasonable, realistic, and we're going to be able to execute. So we're going to talk about appraisals, inspections, documentation, and the due diligence process overall. What are the questions you need to ask, and what are the answers that you should be looking for? That will be Monday, May the 30th of 2022 at 12 p.m. Thank you so much to each of you for attending. It was such a pleasure having all of you here this evening. And of course, thank you to our guest, Christian, who is an absolute wealth of information and one of my all-time favorite investors.